There are Australians right now who haven't set an alarm in years. They wake up when they want. Their money arrived overnight. The number that made that possible isn't as far away as you think, and most people are overestimating it by hundreds of thousands of dollars. Today I'm going to show you the exact amount you need invested to live off dividends in Australia, why this country is genuinely one of the best places on earth to do it, and the single mistake that wrecks most people before they ever get close. Let's start with something that almost no other country has. Franking credits. When an Australian company earns a profit, it pays 30% company tax before it ever touches a shareholder. When it pays you a dividend, it passes that tax credit directly to you. So when you see a 4% dividend yield on the ASX, the real after-tax number is closer to 5.5 or even 6% once those credits are factored in. In the United States, the United Kingdom, and most of Europe, that same dollar of profit gets taxed twice. Once at the company level, once again in your hands. Australia is one of the only countries in the world running a full dividend imputation system. That single fact changes the entire maths of living off dividends here compared to anywhere else. Now, before we get to the number, we need to get the lifestyle question right, because the number depends entirely on the life you actually want to fund. The Association of Superannuation Funds of Australia runs the gold standard research on this every year. For a comfortable retirement, a single person needs around $54,000 a year. A couple needs around $77,000. Comfortable means private health insurance, a car, domestic holidays, and dinner out without checking the account first. If you want the lean version, a single person can live modestly on around $35,000. A couple on around $51,000. And if you're chasing the full version, overseas travel, eating out regularly, upgrading the car every few years, you're realistically looking at $100,000 or more per year. Get clear on your number first. Everything else flows from it. Now here's the actual maths. The ASX 200 average dividend yield in 2026 sits around 3.5 to 4%. Add franking credits and you're looking at a grossed-up yield of roughly 5 to 5.5%. If you target higher-yielding stocks and ETFs specifically, you can push that closer to 6 to 7% grossed up. For the maths, let's use 5.5% as the realistic middle ground for a diversified Australian dividend portfolio. To generate $50,000 a year at 5.5%, you need approximately $910,000 invested. To generate $75,000 a year, you need around $1.36 million. To generate $100,000 a year, you need approximately $1.82 million. And to fund a genuinely luxurious life on $150,000 a year, you're looking at around $2.7 million. Write those numbers down. Because here's the thing most people miss when they first see them. These numbers are achievable. Not just for high earners, not just for people who inherited money, but for ordinary Australians who start early and stay consistent. Here's why. If you invest $1,500 a month into a diversified Australian share portfolio averaging 8% total annual return, you'll reach $910,000 in roughly 19 years. Push that to $2,000 a month and you're there in about 17 years. Start in your late 20s and you're financially free before 50. Now here's the twist almost nobody talks about when they explain dividend investing. Tax. Most people here live off dividends and picture a tax-free life. It's not. But it's better than you probably think. The tax-free threshold in Australia sits at $18,200. And fully franked dividends carry such significant tax credits that a single person can earn close to $30,000 in fully franked dividend income and pay essentially zero net tax. The credits offset the bill almost entirely. That's a $30,000 annual income with nothing going to the ATO. Above that threshold, you do start paying tax on dividends. But even then, the franking credits dramatically reduce your effective rate compared to what you'd pay on the same amount earned as a salary. Now let's talk about the structure most people completely ignore. Superannuation. Holding dividend-paying shares inside super means the income is taxed at just 15% during the accumulation phase. Once you hit preservation age and move into pension phase, that tax rate drops to zero. This is exactly why many Australians chasing dividend freedom run two parallel portfolios. One inside super for long-term tax efficiency, one outside super for income they can access before preservation age. If your plan is to retire before 60, you need both tracks running simultaneously. Now here's the mistake that destroys most dividend investors before they ever reach the finish line. Chasing yield. If you see a stock on the ASX paying a 12% dividend yield, it's almost never what it looks like. Either the share price has collapsed because the company is in serious trouble, and the yield looks high because it's calculated on a lower price, or the dividend is about to be cut the moment the business hits any difficulty. The companies that have paid growing dividends for decades are the boring ones. The Big Four banks. Wesfarmers. BHP in good years. Telstra post-restructure. Woolworths. The major insurers. Not exciting. Not on the front page of the financial press. Just quietly paying you, year after year after year. And that consistency is the entire point. If picking individual stocks feels overwhelming, and for most people it should, the smarter starting point is ASX Dividend ETFs. VAS tracks the entire ASX 300 with a yield of around 3.5 to 4% plus franking credits. VHY targets high-yielding Australian companies specifically and has pushed closer to 5 to 6% before franking in recent periods. There's also BetaShares INCM for monthly income distributions, and iShares IOZ for broader index exposure. For most Australians, a 2 ETF portfolio combining VAS and VHY will outperform the vast majority of active stock pickers over a 20-year period. And you'll sleep considerably better at night. Now let's talk about timing. Because when your dividends actually arrive matters more than most people realize when they're planning to live off this income. Most Australian ETFs pay distributions quarterly, in January, April, July, and October. Individual ASX shares typically pay twice a year, with interim dividends around February or March and final dividends around August or September. That uneven flow is why experienced dividend investors deliberately mix ETFs and direct shares, so income lands more evenly across 12 months rather than in 2 or 4 large lumps. Some build what's called a dividend calendar, mapping out which holdings pay in which months to create something that feels like a monthly salary. That transition from a regular pay cycle to dividend income is psychologically much smoother when the cash arrives consistently rather than in occasional windfalls. There's one more concept that separates the people who actually reach dividend freedom from the ones who keep pushing the date back. The dividend reinvestment plan. While you're still in the building phase, instead of taking your dividend cash, you reinvest it directly into more shares. Your shares generate dividends. Those dividends buy more shares. Those new shares generate more dividends. The snowball builds slowly at first, then faster and faster as the base grows. By the time you flip from accumulation mode to income mode, your portfolio is generating dramatically more than it would have if you'd been spending dividends along the way. Now, there's one final problem to solve. Inflation. The $50,000 lifestyle today costs roughly $67,000 in 10 years and around $90,000 in 20 years if inflation averages 3%. The reason dividend investing still works long-term is that quality Australian companies grow their dividends over time, usually at a rate that keeps pace with or beats inflation. The Big Four banks have grown their dividends by roughly 4 to 5% per year on average across multiple decades, through recessions, through global financial crises, through pandemics. That's the real engine of a dividend portfolio. Not just the income it pays today, but the growing income it pays in 5, 10, 20 years' time. So here's where it all lands. To live off dividends forever in Australia, you need somewhere between $910,000 and $1.82 million invested, depending on the lifestyle you're funding. You get there by investing consistently into quality Australian dividend stocks and ETFs, by letting franking credits slash your tax bill, by avoiding high-yield traps, by using super as a parallel tax-efficient vehicle, and by giving the dividend reinvestment plan enough runway to build real compounding momentum. The Australians who achieve this aren't earning extraordinary incomes. They're investing ordinary amounts, consistently, for a long time, without touching the portfolio until it's ready to replace their wage entirely. That's the whole strategy, and it's available to anyone willing to start. If this gave you a clearer picture of what dividend freedom actually looks like in Australia, do me a favour and hit the like button. Subscribe if you're not already, and turn on notifications so you don't miss the next one. I'll see you there.